I'm Grant Walker. Welcome to Heads Up for Tuesday, the 26th of May, and I'll be back with Last Call for you at 4 p.m. To the new housing tax, the new Brightline test to catch speculators and traders selling residential property within 2 years is unlikely to raise as much tax as the government predicts. The government is ploughing $62 million into compliance and enforcement over the next 5 years, expecting to gather, it says, about $420 million additional tax. It's more likely the Brightline test will catch most of the speculators and investors in Auckland. Property research specialist CoreLogic says its figures show 15% of Auckland's 31,000 residential sales last year had been held for less than 2 years, compared to 9.7% of the 86,000 homes sold nationwide during the same time. In Auckland, almost a third of house sales are held for less than 5 years. Nick Goodall, CoreLogic's senior research analyst, says further investigation of the figures shows when breaking the hold period into yearly buckets, Auckland peaks at less than a year, while for the rest of the country, it's most likely properties are sold within 7 to 8 years. He says some of the properties will be the seller's main home, so not liable for the tax, and we estimate this to account for about 60% of sales. So 40% of 8,400 sales nationwide gives a total of 3,400 properties up for the tax. Mr. Goodall says capital gain for those properties shifted in less than 2 years is $230 million. Taxed at an average rate of 30% is almost $70 million per year. But not all capital gains will be liable, as costs paid for renovations will be taken into the account, so the number would be scaled down further. Century 21 National Manager Jeff Barnett says the analysis confirms residential property speculation is much more pronounced in Auckland, and that government's Brightline test will have the most impact where it's needed most. In that regard, it's well-targeted public policy, he says. Whether it actually slows anything down in Auckland is yet to be seen. To the latest political poll, during May, support for National was up 8.5% to 54% as positive news on the budget was progressively released. The poll, taken May 4 to 17, missed Budget Day, but took in a period that saw key policies released, such as new rules around foreign and domestic property investors and ACC cuts, and key developments such as Finance Minister Bill English confirming his government would miss surplus. The National-led government has its highest level of support since October 2011 and a large lead over a Labour-Greens alliance, with their support at 42%, down 7.5%, according to the latest Roy Morgan poll. If an election were held now, National would win easily and be able to govern in their own right. Looking at National's governing partners, support for the Māori Party dropped 1%, while support is unchanged for both ACT New Zealand on 1% and United Future 0%. The main opposition parties all took a hit. Labour's support is now at 25.5%, down 2%. Greens 10.5%, that's down 3%. New Zealand First 6%, down 2.5%. For the parties outside Parliament, the Conservative Party of New Zealand is 1%, that's unchanged, while the Internet Mana Party Alliance is at 0%, and support for independent others is 1%, that's down 0.5%. In broadcast news, Sky TV says it stitched up exclusive rights to the 2018 and 22 Soccer World Cup tournaments, or FIFA World Cup as most Europeans would call it. The company refused to tell NBR Radio how much it's paid. Sky, faced with increasing competition from streaming video on-demand services, has renewed a string of exclusive content deals recently, securing 5-year rights to most All Black games, plus multi-year HBO and Disney deals covering both broadcast and online rights. Not too much should be read into the deals. It's business as usual, First New Zealand Capital analyst Ari Decker told NBR. Sky TV has always sought 3 to 5 year deals, and while Spark-owned Lightbox Sport has probably pushed up costs in some areas as it competes for content, the FIFA World Cup probably wasn't one of them. He says Lightbox Sport's business model still seems better suited to seasons than 4-week events. It would have been hard for them to pay for it and simply add it into their Premier League Pass product. Sky and Vodafone also announced today that they're expanding their marketing partnership. The pair's latest deal sees $10 a month off Sky Basic for Sky customers who sign on to one of 14 Vodafone broadband and phone plans for a 12-month term. Sky is giving an analyst and investor briefing at 2 this afternoon. The briefing is expected to offer more details on Sky's $120 million plan to upgrade decoders to support on-demand streaming video delivered over the internet.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Monday the 25th. I'm John Stewart. And I'm joined by Jason Walls from our newsroom and Chris Smith from CMC Markets. He's General Manager there. And we're talking market talk, currency today. So, Jason first, the euro fell 3.5% last week. What were some of the factors which influenced this seemingly large weakening of the currency? 3.5's a lot.
It's a lot, yeah. It's quite a dramatic fall. Well, is it? Is 3.5% a dramatic fall? You'd think from...
Yeah, it was.
Yeah.
I mean, morning, Jason, morning, Joe. I mean, 3.5% was something that's probably been expected for the last few weeks. We have seen the euro very strong. We have seen German treasuries certainly rallying over the last few weeks. But the euro's been holding up around 115 against the US dollar and against global currencies when really their economy is very weak across the board. They're rolling out QE. ECB's bond buying program is certainly in full swing. And what we saw last week, we saw the ECB make some comments around front-loading some of their bond buying before the summer period.
That's right. They were changing up some of the times around that, from... was it May and June?
Yeah, it was. So before summer period where liquidity is a bit weaker, we're going to see them continually buying bonds at the same level, if not higher, than what they're currently doing. And what that shows to the market, it shows that there's flexibility in the ECB program. It shows that there's no sign of it slowing down at all. That certainly pushed the euro down to around 110 against the US. Most bank forecasts are still parity, even below parity by 2016-17 on the euro.
Okay, so that far away. Because that was one of the questions I was going to ask you a little bit later. It's like, do we see it happening before the end of the year? But
I mean, I think we can. I think it's already fallen so fast. I mean, what we're seeing, and we continue to see, is central banks devaluing their currency to try and drive export revenue. And the euro, they want a weaker euro. They want the euro down to parity against the US. And now the US are now stepping into the so-called currency wars in their own way because it's damaging some of their export income. But we saw the IMF last week also really hammer France. We're kind of forgetting about France being the second biggest economy in the Eurozone with the whole Greece situation continuing.
Because I was going to bring that up before, actually, because Greece would be quite a big part in this conversation, wouldn't it, when it comes to do with the strength of the euro? I mean, there's almost every single week there's more negative news coming from Greece, isn't there? Yeah,
Greece has got a few more payments next week to the IMF. We also have huge payments due in July and in June.
Are we holding our breaths for that money to be paid up?
Well, what happened last time is when they had the last payments that were due, and it was $750 million, and they didn't actually pay that. They just took that from the reserve,
the pension fund.
Yeah, and so it's just like essentially back to the same level. I mean, they've been doing things like slapping these 18% taxes on tourists. They've been raiding the pension funds, as you said, and it just doesn't look very hopeful for them to. I mean, they've got billions to repay, and if they can't even get to the 750 level, I mean, it's.
Well, they're really just raiding the piggy bank, aren't they?
They are. I mean, look, it's a country of 11 million people. Their GDP or tax revenues around 67 billion, I think, last year, or near that number, and their repayment terms are, there's a lot of austerity required. I mean, they're not a huge exporter of many products. It's more the contagion that Greece defaulting and leaving the Eurozone potentially would have on the market. Portugal, Spain's recovering a bit, but France is a real dire situation. Unemployment is the same level it was in 2007. It's around 11% unemployment.
So that was before the financial crisis as well. So
and the IMF's comments last week were that France, you need to start actually making some measures to drive your economic growth and unemployment. So, more concerns than just Greece.
Yeah.
On the other side of the Atlantic, the US dollar looks to be full steam ahead, Chris.
Yeah, certainly the highest we've seen in the last month. US dollar certainly had a big sell-off over the last 6 weeks, which is what the Fed wanted. The Fed started commenting on the US dollar being too strong. That really hurt US GDP. But higher US dollar is going to happen.
Surely around the rate hike coming up, right?
Yeah, I'm certainly a dollar bull, and we closed at 96 on the dollar index on Friday night. We did go as high as 110 last year, but the US dollar story has to continue when you've got the Bank of Japan, the Bank of England, the ECB, certainly continually doing their quantitative easing. Dollar index, certainly rallied across the board last week. We saw the Kiwi dollar lower against the US dollar, the Australian dollar, the euro, as we just spoke about. Janet Yellen did speak on Friday, which kind of caused a bit of a rally. We also had higher CPI number. Inflation came in a bit better than expected.
Because she said something about the rate hike at the end of this year, right? I only briefly saw the story at the top. I was reading it as I came in, but she actually sort of a little bit of optimism of when it's going to happen, right?
Yeah, she's still leaving this September on the table and this year. I mean, June seems like it's certainly off the table in terms of a rate hike in the US. They're not there yet, was her comment around employment and some of the employment data, but Janet Yellen mentioned a rate rise at some point this year would be appropriate. It's so divided. The Fed is so divided. Every week we see more Fed officials speaking. Some of them are very dovish still on the economy. Inflation is still next to zero, which is delaying the rate hike.
But they did have some good news around inflation this week, though.
Yeah, they did. Core inflation was better than expected.
And unemployment?
Yeah, unemployment, it is getting better and better. The job creation is growing, but participation rate is at 40-year low levels, which means more people are on food stamps, more people aren't looking for jobs. So it's a real mixed picture in the US. But I'm certainly in the camp of a rate rise needs to happen. I would be happy to see it happen in June, because what's going to probably happen is they're going to have to raise rates much faster and much more rapidly than a gradual slow appreciation in interest rates. I mean, 0.25 rate rises is hardly anything that's going to really stamp down growth, I think.
So maybe 0.5% or even higher than that?
Well, I think if they don't go in June or September, they're going to potentially have to go up in much higher moves.
Now, GDP growth estimates are due out this week from both the UK and the US. What are the expectations around these, Jason?
See, I read this and I was sort of a bit, with the UK especially, because didn't their first quarter GDP growth, that was a bit slower than what we would have liked, right? Yeah, Sorry, UK, not US.
Yes, so the UK, this week we're expecting a slight revision to 0.3% growth they saw in the first quarter. They've relatively solid Q1 performance. So did Europe, actually. Europe grew 0.4%, which was actually quite a strong result for Europe in Q1, the strongest since 2011. The US had a dismal Q1, as we all know. They had port disruptions, they had weather-related issues, they had a stronger US dollar. They also have the huge unwind in US energy companies pulling back on capex, pulling back on investment. But they came in at 0.2% growth in the first quarter, which was dismal. And now this week, what economists and analysts are forecasting is for a revision to show the economy contracted maybe 0.9 to 1% in Q1. What's interesting is US GDP, they revise it twice. Into June we'll get another revision, but a lot of hope is on Q2.
Just looking at GDP in the UK, I see Joseph Stiglitz is on record as saying GDP per capita in the UK is lower than it was before the crisis. I presume he means the GFC. That's not a success, he says. Your comment on that, Chris?
Look, I think inflation being as low as it is, marginally above zero in most of these major economies is really making it hard to drive GDP growth. Oil being down, over 50% is certainly making it hard also. The fact that the Conservatives have got back in the UK is certainly a positive thing for the equity market. Still, the FTSE's at record high levels. The pound had a really strong week last week, certainly against the Kiwi, off
47, was it?
Yeah, off 6%. So for New Zealand investors having offshore exposure, it's certainly been a good thing that the pound and the US dollar are strengthening. But UK economy, from what I'm hearing, and the fact that the Conservatives and that stability is back in, is certainly going to. You'll probably see some more growth there. But oil being where it is certainly keeping inflation next to zero, and that's a big concern for central banks.
The big financial story from last week was the 5 banks, and huge banks they are, which were fined close to $6 billion. What's your take on that?
Yeah, because we were talking a bit about that on Friday, weren't we? So it's $6 billion, and it was these people, the cartel, if I remember correctly, right?
Yeah. This has been going on since June 2013. It's been an investigation that's the FCA kicked off in the UK back in October, made the release that they were working with the banks. I'm not surprised. It's quite complicated. It looks terrible on the face of it that these banks had been manipulating prices for their own benefit. There could be huge civil lawsuits placed against these banks from big corporations that have lost out on worse rates than they should have been receiving from these banks. $6 billion in fines, the biggest fine for Barclays, like in Britain ever. Terrible for the industry because the FX market relies on these major banks to create the pricing and liquidity. It's not a central exchange like a stock market. You're very reliant on these major banks. being a fair place to do business and create prices that the world effectively trades on globally. That it's concerning, but I'm sure the banks have made a lot more than the $6 billion in fines over how long they've been doing this. And there's lack of criminal convictions. A few traders are being fired, but what's surprising, and from the GFC, is the lack of criminal convictions across all of these fines.
Now, just finally and very briefly, Jason, what can we expect to be seeing in the week ahead?
Oh, well, I'll throw that one to you, Chris, actually.
Yeah, I think locally, Frontiera on Wednesday, if it comes out on Wednesday, the forecast for the upcoming season, it's a major event for our local market. We've got some key earnings out from local companies. We saw Contact today doing a special dividend, but
we've got something coming up online about that as well, so we'll have...
Right. Good.
Yeah.
We will watch with interest. Gentlemen, thank you both very much.
Thanks, John.
Cool.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In business news, Netflix says it's fixed a problem that saw Australian and New Zealand customers charged multiple times in the same month. Social media lit up with complaints yesterday, with some people saying their credit cards had been billed 8 or 13 times. A spokesman for Netflix, Jai Tatani, told NBR Radio the problem has now been fixed and only affected a small percentage of New Zealand and Australian subscribers. The spokesman says while no extra money was withdrawn from users' accounts, it may take several days for the authorisations to drop from users' bank accounts. One user complained, "You took $194.87 out of my bank without my permission, the money that was there to feed them. Then I have to wait 7 to 10 days for my money back. Who is keeping the interest you're earning on my money? And then there is nothing I can do about it." But Mr. Tatani is sticking to the company's line that no extra money was actually taken out of accounts. He says authorisations are counted as holds at some banks. While the money is still there, the bank counts it as subject to withdrawal until the hold's clear. To the New Zealand dollar. The dollar was little changed overnight, with major banks in the US and the UK closed for public holidays. The Kiwi held at 73.05 US at 8 this morning from 73.06 at 5 yesterday. The TWI edged up to 76.04. Currency markets were subdued overnight, with US markets closed for a Memorial Day holiday, while the UK market and much of Europe were closed for a bank holiday. ANZ Bank New Zealand Chief Economist Cameron Bagri and Senior Foreign Exchange Strategist Sam Tuck said in a note, "It was a quiet night overnight with the key US and UK markets closed. The New Zealand dollar moved in a sideways manner." So today, traders are awaiting the latest New Zealand trade data, with economists in a Reuters poll expecting the monthly trade surplus narrowed to 100 million in April from 631 million in March. The annual trade deficit is expected to widen to 2.79 billion in April from 2.41 billion in March. The New Zealand Institute of Economic Research publishes its quarterly economic forecasts today, and the Reserve Bank releases April data on new residential mortgage lending within its loan-to-valuation limits. Tomorrow, the focus will be on the outcome of Fonterra Co-op Group's board meeting. The world's largest dairy exporter is expected to provide its first forecast for the upcoming 2015-16 season Thursday morning, with ANZ forecasting an opening milk price of between $5 a kilogram of milk solids and $5.25, which it says will leave many dairy farm budgets in the red. In the US tonight, traders will be eyeing data on durable goods orders, services, PMI and consumer confidence as they firm up expectations for when the Federal Reserve is likely to start raising interest rates. The New Zealand dollar, little change, 93.33 Australian, 66.52 euro. It slipped to 88.76 yen and held at 47.21 British pence.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
Let's talk global mode. MyRepublic has thrown in the towel over global mode. The Singapore-owned ISP has sent an email to customers last night saying it will pull its fibre TV service at 3 a.m. on Wednesday. The email, which sparked complaints from 3 customers to NBR Radio, gives no reason for ditching the service. Fibre TV is MyRepublic's equivalent to the global mode service offered by Call Plus through partner Bypass Network Services. It allows anyone who belongs to MyRepublic to access offshore content services normally blocked to Kiwis such as Netflix US and BBC iPlayer. A raft of small ISPs folded when Sky TV, TVNZ, MediaWorks and Lightbox owner Spark threatened legal action over Global Mode. All told NBR they believed the service was legal, but said they could not afford a legal fight against four big companies. Call Plus, owner of Slingshot, Orcon and Flip, Bypass and MyRepublic ignored an ultimatum from Sky to abandon Global Mode, with MyRepublic New Zealand boss Vaughan Baker emerging as one of the fiercest critics of the Big Four's legal move. He told NBR the service remains, we don't respond to threats. For more on this, go to nbr.co.nz. In business news, Mad Group has plans to launch its Habitual Fix brand in the US after drafting plans with a US master franchisee. The food company, which also owns the Mad Mex burrito chain, is currently attempting to raise a minimum of $750,000 with a cap of $1.5 million, a 13% stake on equity crowdfunding website Snowball Effect. It signed a memorandum of understanding with an undisclosed US partner. The company expects a franchise agreement to be signed by the beginning of August. The deal will be for an initial term of 10 years with a 10-year right of renewal. It expects the first Habitual Fix store in the US to open in Los Angeles in the first half of 2016, with a minimum of 30 stores opening in the initial 10-year term. Chairman and Managing Director James Tucker told NBR Radio he can't divulge the percentage of royalties that the US partner will deliver. However, he expects the deal to add more than $400,000 in earnings before interest and tax in 2016, over $6 million in franchise royalties over the initial term, and then more than $1 million a year for the following 10 years if the right of renewal is exercised. Asked if there are plans for Mad Group to eventually handle the US business, Mr. Tucker said, we've allowed for that if we want to be hands-on. Mr. Tucker says the deal is the first tangible evidence we can point to of the strong inquiry level Habitual Fix has received from interested country master franchisees. He says the founder and chief executive of the US partner is particularly entrepreneurial and has a number of years of experience working for McDonald's in many countries, including in the US. Mr. Tucker says there is growing consumer awareness in the US about what people are eating, and the fast food giants are battling headwinds. Habitual Fix is well positioned to take advantage of this changing trend and turn Americans into food junkies, not junk foodies. Details of the US memorandum for a Habitual Fix are not factored into the memorandum for the capital raising. At press time, the company had raised 29% of its minimum with 21 days remaining. The group made a $347,000 net loss after tax on revenue of $2.88 million in 2014, but expects to become profitable by the end of June this year, predicting $112,000 net profit on revenue of $5.38 million. In 2018, it expects to make $1.86 million net profit on revenue of $17.96 million. The company says it produces about 20,000 meals a week and values itself at $9.8 million, which will increase to $11.3 million if the maximum funding target is reached. In market news, New Zealand Oil and Gas has sold its 15% stake in Pan Pacific Petroleum into a takeover offer from one of its own directors at 5 cents a share, despite the offer being tagged as unfair in an independent report. The block of about 88 million shares was transferred on market on Monday. NZOG Chief Executive Andrew Knight confirmed his company had sold its Pan Pacific stake. He said, for us, it was a judgment call. On April 10, Pan Pacific was informed of a takeover offer at 5 cents a share from Zeta Resources, an ASX-listed company associated with NZOG Director Duncan Saville. In April 24, Pan Pacific's directors issued a target company statement advising shareholders not to sell, saying an independent report had assessed the offer as neither fair nor reasonable. Valuer RSM Bird Cameron said Pan Pacific was worth between 7.5 and 12.5 cents a share. Mr. Knight said NZOG had looked at the information in the independent report compared to its own assessment of value and the likely scenarios. He says, we're aware of the various statements that directors have put out and assessed that in our view for NZOG it made sense to sell. He said a benefit in accepting the offer was certainty. He said the comment from the Pan Pacific directors on Thursday or Friday didn't really provide certainty. The offer that's sitting there gives us the opportunity to get some certainty around the value. Mr. Saville had played no part in the decision to sell, according to Mr. Knight. Zeta had about 17% of Pan Pacific before the takeover offer, which closes tomorrow, that being Wednesday. In a supplementary bidder's statement issued to the ASX yesterday, it drew attention to the certainty provided by its 5 cent offer and said Pan Pacific's board's intention to seek other offers amounted to a decision to wind up the company, with no certainty the assets could be sold for a greater value. Pan Pacific owns minority stakes in oil production and exploration assets, including 15% of New Zealand's Tui fields, 2 exploration blocks in Vietnam and 1 in Indonesia.
NBR Radio. With the Property Press. It's out now to show you around.
NBR Radio, Monday the 25th. I'm John Stewart, and I'm joined by our political editor who's up here in Auckland today from Wellington, Rob Hosking. Now, Rob will be looking at the week ahead, but also, I guess, we've got to look back a little bit to last week's budget. What sort of fallout do you think we can expect from that for this week, Rob?
Well, we're already seeing it to some degree. I think there's a bit of a feeling that the Muldoonist label has been raised. I think to some degree that's exaggerated, but there were a number of tinkering with taxes. The departure tax is a classic Muldoon move.
It is.
And there's been a number of other tinkering around those sorts of things, which and starting to annoy a few people. There's the telecommunications levy as well, and there's, I suspect, as this week goes on, ministers are fanning out around the country, particularly around Auckland, I have to say, discussing the budget and effectively selling the budget to mostly, but not exclusively, to business audiences. And I suspect that there might be a few fleas in ears as the week goes on.
What sort of fleas?
Oh, just a feeling that some of these levies are a bit unexpected and a little bit no new taxes and then these things. And I think the other thing is a lot of business people are concerned about the superannuation issue, and that's one that just cuts across every sector, really, that concern. And the government is
What
still...
sort of concern?
Oh, just that the government is, National's attitude to superannuation is effectively, what me worry, and that she's apples and nobody needs to do anything about it, when pretty much everyone who looks at the demographics and can draw lines and can add up is saying, well, no, you need to make some changes now. And National is frightened of its own shadow to a degree here because of what happened in the 90s. What annoys me is I think they've really drawn the wrong lessons from that, because really the political damage was caused then, and it was to Labour back in the 80s, by saying, by springing surprises on people to something that really requires long-term planning. The lesson to me surely is not, don't change super. It is give people time to adjust when you can see a crisis coming before the crisis gets here. And that's something that's just not happening now, and it is quite irresponsible, I think.
Now, on the whole question of superannuation, Andrew Little appears to have perhaps put his foot in his mouth as regards the question of means testing super.
Well, the thing about this is, somebody once said that a gaffe in politics is when a politician accidentally tells the truth. And that's effectively what he did, to some degree anyway, partially, because he said, look, it's not sustainable in the current model. They've taken raising the age of entitlement off, which was their policy at the last election. Now, I think that's a mistake. I think, lifting the age, which is what pretty much every other country is doing, is the sensible thing to do, and you do it, you flag that it's going to happen, and so people can plan for it. The alternative, of course, is the means test, means or asset test, and he was asked about superannuation. He said, well, raising the age was unpopular, so we're not going to do it, but maybe we should means test, and of course that was going to get the headlines. That's a big deal.
Well, I mean, a politician tinkers with superannuation at his own peril, doesn't he, or she?
Yes, they do, but somebody has to, both sides, and again, so, basically in doing the U-turn within, an hour or two of his comments and saying, no, I didn't mean that, or what did he mean? I mean, it was pretty, I was present at that breakfast. It was a sponsored one between NBR and Grant Thornton. and it was pretty damn clear what he said. So really, it was a straight-out, okay, default position, let's be just as responsible as National.
Was he shooting from the lip, though?
It was in response to a question.
Right.
But it actually wasn't a bad answer.
Mm. Well, I guess this coming week, I mean, he hasn't really had any comment to make since Friday, has he? Do you think he'll be coming out and trying to set the record straight and explain to us what he meant?
What worries me is that neither of the main parties seem to want to talk about this at all. And Labour was gearing up to have a go at National for its, putting its fingers in their ears and humming very loudly on the issue of super. And because of Little's comments on Friday, I think they're not going to want to go near that topic. And so there's going to be, it's very annoying that you're going to have the two main parties who are too scared to talk about this. And I suspect, unfortunately, that they just won't go there. And until Little's comments on Friday, they were very much going to go there this week, because that was a big attack on National in the wake of the budget, that they were just being not responsible enough and negligent and reckless, I think were the words Andrew Little used, and he's dead right there.
Yeah. You think they were being a bit reckless?
But, National, yes, by just basically saying, look, we're not going to look at raising the age of entitlement or doing anything about that increasing chunk of government spending that is going into superannuation. I think you do have to look at those longer-term issues and say, well, look, the better off, maybe we do need to means or asset test if practicable. Now, I've got some questions about the practicality of that. But, again, I come back to, one of the few Labour policies I thought was quite central at the last election was that raising the age. In fact, I think they should have probably gradually said they're going to move it to 70, which is what a lot of other countries are doing. But instead, now it's suddenly, we were burned, let's all run away from this. Well, that we've got that pension, which kicks in at 65, is now being paid to people for around 20% of their lifespan. It was never meant to do that.
Yeah. I guess, to be charitable, one could say that Andrew Little was trying to put these questions on the agenda for public discourse over the next year or two.
Oh, I think he was. And like I said, his first reaction, I think, whatever you think of the means test issue, I think was dead right. These things do need to be discussed. But, like I say, within a couple of hours of those comments, he's run away from them.
The Aussies have asset testing, don't they? But it kicks in at a fairly high level of income.
And they have compulsory super as well, of course.
Indeed. Yeah, they do. Now, just looking ahead to the Greens leadership, I think the party at large decides that this coming weekend.
Yes, that's right. They've had a bunch of regional roadshows with the four candidates.
Who are those candidates?
There's Kevin Haigh, who's understood to be the front runner. He's List MP based down West Coast. Has a very long-standing career in various activist causes going back to the late 1970s.
He's very green, isn't he?
He is. He's a very affable guy. He's, people find him right across politics very good to work with. I think that's led to some misconceptions that he's maybe not hugely left-wing. I think, he's a very committed left-wing activist. But the way he conducts himself is quite moderate, if I can put it that way.
Who are the other three then?
There's James Shaw, who's Wellington-based List MP, who was very much a late entrant because he's only been in Parliament since last election, but who I gather is making quite a strong running. And then there's Gareth Hughes, who's been in Parliament for a while. And there's a fourth guy who's not in Parliament, whose name I can't recall. Sorry.
Right. Oh, well, let's rate his chances fairly low down the list. Well, it looks like we've got a reasonably interesting week ahead, and I'm sure there'll be more public discussion on those superannuation issues that Andrew Little has raised. Thanks very much for your week ahead, Rob.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
I'm Grant Walker with Heads Up. Here's what's trending on NBR Online. Habitual Fix heads to the US. Pacific Edge slammed by the FMA. New health and safety laws likely to be softened. NZOG sells stake in Pan Pacific. Shares in Mac owes about $16 million. And the new housing tax might not be as good as the government hopes. If you're travelling today, Auckland wet and windy. Wellington fine. Christchurch cloudy. And Dunedin cold, windy and wet. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up right now on NBR Radio. To health and safety, Prime Minister John Key said health and safety reforms sparked by the Pike River coal mine disaster look set to be softened either by a select committee considering new legislation or by the Cabinet. The Health and Safety Reform Bill is due to be reported back to Parliament from the Transport and Industrial Relations Select Committee this week. Although Mr Key denied a report from the Political News Service that former Small Business Minister Maurice Williamson was contemplating crossing the floor to vote against the bill, he acknowledged that concerns about the scope of the reforms were being raised with MPs by members of the public as they moved around the country. Mr Key said, "If I go around New Zealand, it's an issue that gets raised with me. Particularly small businesses are concerned about how it would be administered and would it be fair? How onerous would it be for them to comply and would it be effective?" He said that's a genuine debate that members of the public are having with our caucus and it's something the Cabinet's going to have to consider. He said, "I've made it quite clear that when it comes back from the Select Committee, we're going to toss it around in the Cabinet and make sure that we're happy with the recommendations and the settings." The legislation is one leg of a suite of reforms undertaken after 29 miners died at Pike River in a mine that lacked both essential life-saving infrastructure and rigorous health and safety practices. An independent health and safety task force led by Shell New Zealand Chairman Rob Jager made recommendations touted at the time as the most sweeping review of New Zealand health and safety structures ever undertaken, with the aim of reducing workplace deaths by 25% by 2020. A new entity, WorkSafe New Zealand, was created under the auspices of the Ministry for Business, Innovation and Employment to oversee the new framework. The bill allocates duties to the person or entity in the best position to control risks to health and safety, as appropriate to their role in the workplace, defined as the person conducting a business or undertaking. Among concerns Mr Key was willing to acknowledge was the treatment of volunteers and the liabilities of voluntary organisations. New requirements for worker participation will give wide powers to elected health and safety representatives. To politics, Maverick National MP Maurice Williamson has assured Prime Minister John Key he does not want to join the ACT Party. Mr Key told his post-cabinet press conference yesterday, "He sent me a couple of text messages. He's not interested in leaving National and joining the ACT Party. If he wanted to go to the ACT Party, he's had ample opportunity to do so. He's happy to be the national member for Pakuranga." The issue blew up after ACT Party leader David Seymour included a little nugget in his weekly newsletter to the effect that former leader Don Brash had approached National MP Maurice Williamson to defect to ACT. The item, a throwaway tidbit at the end of the newsletter, saw Mr Seymour almost knocked down in the media rush, and he told NBR Radio ruefully, "I wish I could get this sort of media interest in our tax policy." Mr Seymour says the approach from Dr Brash was to ACT Party President John Thompson about 10 days ago. He says, "John phoned me somewhat gobsmacked after meeting Don Brash in a cafe. I did my due diligence around the board and they were all unanimously against the idea." Mr Thompson has since tried to contact Mr Williamson, but Mr Williamson has not replied. Dr Brash would not comment on the issue when approached by NBR. Mr Williamson could not be contacted. The idea of the Pakuranga MP going to ACT is not a new one. Mr Williamson is one of the few remaining market liberals in the National Party caucus, and there were murmurs of an approach after he was booted to the backbenches last year after contacting the police who were investigating a constituent who also happened to be a large National Party donor. But it goes back further than that. 20 years ago, when ACT was still being set up, Mr Williamson was regarded as a likely defection from National, not just as an MP but also as party leader. Writer and then ACT Party insider Simon Carr recounted in his book The Dark Art of Politics that talks went on, but although the Pakuranga MP was keen, it was he who had made the approach. There was no follow-through, no run of speeches setting the scene for a break with National. So it seems this time around. Mr. Seymour says there has been no further action since the discussions 10 days ago, and neither does he expect there to be. ACT President John Thompson says the party is not interested in recruiting existing MPs from anywhere. He says, we've just released our Liberal Tribe prospectus, and we're all about going forward. We don't want to be the resting home for politicians who come from other parties. That isn't what we are about. To liquidation news. The liquidator's first report shows interior design company Shears & Mac was forced into liquidation after major debtor disputes in Australia. As reported previously, liquidators McDonald Vague were appointed on May 14 to New Zealand's largest commercial interior fit-out company, whose clients include Fisher & Paykel, Louis Vuitton and Vodafone. The liquidator's initial report, released late yesterday afternoon, says the company failed as a result of delays in planned work, lack of working capital and material debtor disputes in Australia. At the date of liquidation, there were 19 registered New Zealand creditors owed more than $12 million. Australian creditors were owed about $4 million. ASB Bank is the first-ranking creditor and owed about $3.75 million, while second-ranking creditor is 90% shareholder Furnish Investments, owed about $5.3 million. The liquidators estimate there is $863,522 owing to former employees for wages, holiday pay and redundancy pay, of which $716,500 is preferential. Inland Revenue is owed about $170,000 and unsecured creditors are estimated to be owed $2.66 million. Liquidators say the amount paid out will depend on the creditor's ranking and how much can be recovered, with the total unpledged assets having a book value of $7.95 million. The company's Australian branch, Shears & Mac Australia, is also in liquidation. A preferential claim of 39,000 Australian is owed to former employees for holiday pay. The Australian business owes unsecured creditors 2.12 million Australian, although 1.7 million of that is a loan to its New Zealand parent. Shears & Mac was tipped into liquidation by its two shareholders, one of which is Furnish Investments, but ultimate ownership is unknown since all shares are held through a trust associated with law firm Claymore Partners. Liquidator Jared Booth would not confirm whether Shears & Mac's sole director Craig Wilson was also the ultimate beneficiary of that trust. Mr. Booth says the liquidation is still at an early stage and detailed disclosure may prejudice asset recoveries, including litigation.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
In market news, Justin Prain and Mark Schroeder, directors of the formerly NZX-listed Apple Fields, have been fined $30,000 each for failing to file financial statements for 3 years. According to Judge Emma Smith's February judgment, the Christchurch District Court found the two directors failed under the Financial Reporting Act to report Apple Fields accounts. The Financial Markets Authority brought the charges against the two directors after they failed to report the annual accounts for the financial years between 2011 and 13. The FMA can seek fines of up to $100,000 for failure to report. Christchurch-based Apple Fields, which listed on the NZX in 1986, was once New Zealand's largest corporate orchardist and clashed with the Apple and Pear Marketing Board for the right to export fruit independently. The company moved into property development in the early 2000s, with Mr. Prain appointed a director in 2002 and Mr. Schroeder in 2003. Apple Fields entered into a property development arrangement with Noble Investments in Christchurch, which was planning to subdivide land on Yaldhurst Road into 254 residential sections, as well as develop a village centre, according to the judgment. After changes in the joint venture, Noble Investments could be considered a subsidiary, and its accounts needed to be included in Apple Fields Group accounts. The Yaldhurst development stalled when Apple Fields ended up in a protracted legal battle with neighbouring landowners. Prain and Schroeder defended the charges brought by the FMA, arguing that difficulties in obtaining auditors for the annual accounts and complications over obtaining Noble Investments accounts was the reason for the non-filing of Apple Fields accounts. Judge Smith accepted there can be extenuating, unusual intervening circumstances that might mean a company is quite unable for a period of time to complete accounts, but the circumstances presented by Prain and Schroeder didn't prevent them from signing accounts complete as far as they can be complete and qualifying there should be more information. Judge Smith wrote in the judgment the directors failed to take all reasonable and proper steps to ensure the applicable requirements of the Act were complied with in failing to submit the accounts to the auditors, and Apple Fields cannot be a non-compliant issuer on an indefinite ongoing basis. The FMA's Director of Enforcement and Investigations, Belinda Moffat, said the fines reinforced the expectation that issuers of securities will file timely and accurate financial statements. Ms Moffat said in a statement if they're unable to comply with the regulatory requirements, then they need to consider whether they can continue to be issuers. The case was taken following the Financial Markets Watchdog's 2013 review of compliance with the financial reporting law, which has seen 7 directors fined. Apple Fields delisted from the NZX in 2010 after its shares were halted for failing to report its annual accounts for the year ended September 30, 2009. In development news, a community group fighting for amendments to a Fletcher building residential development has a secret weapon. This week, Three Kings United Group expect to give its submissions on Fletcher's plan to rezone the 15.2 hectares Three Kings quarry to develop 1,500 residences. The president of the community group of 65 members, Gary Bryant, says the group is bringing in basin flyover hero Richard Reid as its expert witness before a panel of planning commissioners. Mr Reid had a strong hand in convincing a board of inquiry into Wellington's basin flyover to change its tack by offering a tunnel alternative. Mr Bryant says now the Auckland architect has designed an alternative for Three Kings Quarry that enables more green space. The community group leader says Mr Reid's design will have more green space but proposes taller apartment complexes. Mr Bryant says he expects the case to go to the Environment Court regardless. Mr Bryant says we accept there will always going to be development here, but this is 4 times the intensity of Stonefields, comparing the project with another Fletcher's residential development in East Auckland. Fletcher's proposal says the development will be a vibrant, sustainable urban village on the former Windstone aggregates and Mount Roskill Borough Council quarries and the adjacent land at Three Kings. Of the total land parcel of 21.6 hectares, 15.2 is owned by Fletcher, while the rest is owned by the Crown. A land swap with the council is underway in parallel with the plan change application. Fletcher's application says the development will include various types of accommodation, including apartments and terrace housing, as well as an open space network comprised of 2 high-quality, high-use sports fields and a broader network of walkways and cycleways. The hearing is taking place before a panel chaired by Les Simons and including William Kapea, Nigel Mark Brown and Malian Absalom, and is expected to wrap up on Wednesday. Fletcher, which presented its plan last week, will have a right of reply before the hearing closes. In market news, the Financial Markets Authority has slammed biotech minnow Pacific Edge with a $500,000 compensation payout for slow disclosure of 2 big US deals. In a statement to the stock exchange, the FMA said Pacific Edge had probably breached listing rules in 2013 when it announced 2 distribution deals for its cancer diagnostic tool Cxbladder days after they were signed. Failure to make the disclosure in a timely way means that shareholders who traded in shares may have done so without having available to them all material information regarding the company and without the market price of the shares when sold reflecting that price impact of that material information, said the FMA. Shareholders who sold between the 2 events were entitled to compensation, the FMA said. Pacific Edge has agreed to make $500,000 available to pay them out. Pacific Edge chairman Chris Swan said the delay of the announcements in question was not made with an intent to breach continuous disclosure, but rather to meet the specific needs of the US contractual counterparties. In October 16, 2013, Pacific Edge announced it had signed an agreement with FedMed, a national preferred provider network in the US, to make Cxbladder available to 40 million Americans. The share price on October 15 was 50 cents and rose to 66 cents on the day of the announcement. On October 22nd, Pacific Edge announced another deal in the US, this time with America's Choice Provider Network. From 72 cents on October 21, Pacific Edge shares soared to a close of 106 on October 27 and reached 158 by October 24. For the 6 months to September 2014, Pacific Edge reported revenue of $1 million and a net loss of $4.9 million. Its cash available at balance date was $14.7 million. The company will announce its full-year results on May 28. Pacific Edge's Cxbladder product is a diagnostic test that enables non-invasive detection of bladder and other urinary tract cancers from a small volume of urine.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
To local body politics, Rotorua Lakes Council Chief Executive Jeff Williams is recommending 4 of his councillors either resign from the Rotorua Pro-Democracy Society or else not participate in the council's vote today on its Te Arawa partnership model. The Society's Secretary, Dr Reynold McPherson, says the councillors will ignore the recommendation and has dismissed it as the latest attempt by Mr Williams to intimidate councillors in what he described as a silly sideshow and a challenge to find a workable compromise to improve Te Arawa's contributions to council decision-making while complying with democratic principles. In addition, Mr Reynolds says he's been publicly chastised by some senior personnel at the council for having spoken to the National Business Review earlier this month about its move to nominate unelected Te Arawa-affiliated members to key committees. Following a 7-week period of public consultation, more than 200 residents have made submissions on the proposed model, which was originally proposed by the Council in May 2014 and which councillors will vote on in today's extraordinary meeting. In a May 21st media release, the Council said that some of its councillors' actions could amount to predetermination and put the May 26 decision at risk of judicial review. Referencing a report it commissioned from legal advisers Tompkins Wake, it said if judicial review of the ultimate decision eventuated, councillors' actions would be scrutinised by the High Court to determine whether their declaration of an open mind was credible and could be upheld. Mr Williams says in the release those councillors have a conflict of interest between their obligations as elected members of council to keep an open mind in respect of decision-making and as members of that society. In order for those councillors to resolve this conflict, I recommend they consider either resigning their membership of the Rotorua Pro-Democracy Society or stand down from deliberations and final decision-making. However, Dr McPherson has described Mr Williams' comments as bully boy and ran-through tactics and that today's Rotorua's councillors face the decision of their political careers. He added that in recent days the Society has developed and measured support for 4 alternatives: Māori wards, the Lakes Community Board model, rural and lakes wards, as well as a mayoral working party. Let's talk surveyors. 70% of the world's wealth is tied up in property. That bold figure, says Louise Brooke-Smith, the global president of the Royal Institute of Chartered Surveyors, or RICS, is the reason that governments listen to the organisation. Not only is the world's wealth tied up in property, it also drives most of the globe's GDP. Governments are worried about what's being built and the capital investment required. Property's importance globally led to RICS becoming one of the leading organisations in setting up international property measurement standards. The way property assets such as offices, industrial property and shopping centres are measured varies dramatically from country to country, and a coalition was formed during a World Bank meeting in 2013 to standardise measurements. New rules introduced in November aim to stop practices such as including common space, lift shafts, communal hallways, off-site parking, and even swimming pools in floor measurements. The different methods were making it difficult for property investors, developers and tenants to accurately compare space. Research shows that depending on the method used, a property's floor area can deviate by as much as 24%. Dr Brooke-Smith says we're working to embed the single property measurement standard globally. The measurement standards are better for investment and give confidence to the market globally. Dr Brooke-Smith says governments are signing up to the standardised measurements. She says it's not rocket science but common sense, bringing together common practice and eliminating the quirkiness. Insurers are signing up, as has Vodafone globally, the Property Council of New Zealand and sections of Auckland Council. The work on offices is being followed by measurements for construction standards, and a draft will be out by the end of next year. Dr Brooke-Smith's year as the first female RICS president has also involved work on encouraging more women in the property industry at a professional level. She is a land economics specialist, an area where planning and policies can make a big difference. She says there are a myriad of issues such as getting the planning right, land uses, infrastructure funding, and being able to pay for it are universal around the world. Another issue confronting the industry around the world, says Dr Brooke-Smith, is the diversity and exclusivity of the profession. The surveying, value and real estate areas, she says, have been seen as a male preserve. We need to broaden both the gender and social diversity. It has to change. The number of women in the profession has not even reached 50%. She said, when I first started 30 years ago, women made up 2% of the profession, and it still sits at about 10% in the UK. Dr Brooke-Smith says it's about perception and historic culture. She said there's no part of the built environment women can't work on. She says Christchurch has noticed a skills gap in the earthquake rebuild. This is not only specific to New Zealand, but is also across Asia and the sub-Saharan Africa. Dr. Brooke-Smith says we need women in the built environment and a change in culture and attitudes across the whole profession.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
To business news, early childhood education provider Evolve Education will focus on organic growth as well as acquisitions this year after beating prospectus forecasts. The company, which was formed mid-last year by Australia's Kern Group to roll up New Zealand's fragmented early childhood sector, released its first annual results yesterday since listing in December. The Auckland-based company reported a net loss of $8.1 million in the period from May 2014 to March 31st, 2015, which was smaller than the $9.5 million forecast in its November prospectus. Underlying earnings before interest, tax, depreciation and amortisation of $1.8 million were more than twice the $816,000 forecast, while revenue of $32.9 million was 14% above the forecast. Evolve Chief Executive Alan Wham told NBR Radio he is very happy with the results as management has been busy ensuring the large amount of acquisitions work well together. He says for them to perform like that is very pleasing indeed. At the centres, the teachers have maintained their focus on providing good quality early childhood education, which says to us integration has gone really well. Evolve completed the acquisition of 86 ECE centres in the results period, one more than forecast, and has since bought another 8 centres and has 4 more under contract. The accounts show the company paid $169.5 million for these businesses. The main acquisition was 30 centres from Lollipop's Educare for $66.7 million, paid for by a combination of cash and shares. Evolve also paid $1.5 million cash for the remaining interests in 2 Lollipop's joint ventures in Hastings and Birkenhead. Evolve spent $14.6 million buying home-based educators Au Pair Link and Porse In-Home Childcare and its related companies. The group also acquired 56 centres from a number of separate sellers, including Wellington-based iKids and Christchurch-based Artemis Learning for $86.2 million in cash. Mr. Wham says while the company will expand through further acquisitions this year, it has enough headroom in its banking facility to pay for these. It also wants to focus on organic growth. He says obviously we want to build clusters around where we've already acquired for operational efficiency. The company says it has $2.5 million in operational cash flow and held cash and equivalents of $4.6 million as at March 31st, with $90 million of bank debt undrawn. Chairwoman Nora Barlow says the company is on track to meet guidance for 2016, which includes a forecasted profit of $16.6 million on sales of $136 million and an interim dividend payment of $4.6 million. Evolve shares have moved 3% yesterday to $103, just up from its IPO price of $1. In business news, a Tim Manning company has won a legal application to set aside a statutory demand but has been ordered to pay almost $15,500 in costs. The case involved the Auckland developers company Norwich Properties, which acquired Arthur's Point Coronet Peak near Queenstown for $5.5 million, with plans for a $4 million upgrade. Architect Mark Gray was engaged for the project beginning in September 2012, but became frustrated at lack of payment. Mr. Gray's evidence to the court claims there was a pattern of slow payment of his invoices in spite of repeated promises they would be paid. He instructed his solicitor to write to Norwich demanding payment, but Norwich failed to make payment, and Mr. Gray's solicitors issued a statutory demand for $41,572 for his work. They gave notice under number 9.74 of the High Court rules requiring Mr. Manning to appear for cross-examination. They also stated that Mr. Manning had misled the court by asserting that Norwich did not engage Mr. Gray. In one of Mr. Gray's affidavits to the court, he says Mr. Manning at one point told him if he did not withdraw the statutory demand, Mr. Manning would fold the company and proceed with the project using another company. By the end of November 2014, Mr. Manning accepted the debt, but the statutory demand remained live. It required Norwich to seek leave of the court to set aside the statutory judgment, and proceedings were filed to that effect. Norwich only paid the invoice on April 25 before the hearing on May the 5th. According to Associate Justice Robert Osborne, and I quote, "I'm satisfied that the appropriate and just outcome is that Mr. Gray should recover his costs and disbursements on an indemnity basis, subject to the courts being satisfied that they are reasonable in the sense that a reasonable observer would expect those costs for the attendances involved."
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.